of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think that it's important for investors to take pause and reassess their portfolios in this volatile market.
Bonds are down, but not out.
Q1, it seems to me like it's going to be a messy quarter.
There's a little bit of Peloton in everyone. Okay, there's a little bit of Netflix in everyone.
We are starting to see some growth areas of the market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
There's a little bit of Peloton in me, and I mean a little. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. We say good morning. There's 3 of us. Pick out the one that possibly would be on a Peloton. It is not me. John, the distraction of Peloton moves us away from Thursday. That inflation report is front and center.
I have to say it's not me either. The median estimate is 7.3% on inflation in America this Thursday, year over year. 7.6 the high, 7 the low. We're having a conversation, Tom, about what would happen if we got a big downside surprise.
Yeah.
On inflation, how this market would recalibrate its expectations for March and beyond for this Federal Reserve.
My single date is March 11 meeting, and you really wonder here about what we're going to see Thursday and the outcome, up, down, sideways, and that. But John, I agree with you. It's a vision out past March, the data that we'll see, the data dependency of the Fed up to that March meeting.
And as you get deeper into some of the base effects should help out this Federal Reserve. To what degree, I don't know. But right now, we're building a lot into the front end, up 60 basis points on twos, Tom. Year to date. Yeah. It's a big move, and it's happened very quickly.
Lisa, the base effect, as I see unleaded AAA gas, 344. That's up nicely from the dip. I'm going to say it was September, maybe October as well. I mean, a gallon of gas is front and center for too many.
You make a really great point. The base effects that were supposed to wear off are not wearing off as much. Yes, the pace of increase perhaps has declined for certain areas, but you're seeing supply chain disruptions persist. You're seeing oil prices rise. And then, of course, you have that rents and services component environments as wages start to take off that also are contributing, Tom.
Lisa, it's 8:02 a.m. Wall Street time, and I have failed because one of the shifts in the zeitgeist overnight is the idea of full faith in credit analysis out to outright credit analysis. What is the knowledge and state of the credit market right now? What is it doing versus everything else?
There's a tension here because you're starting to see extra spreads, the extra yield that people earn over benchmark rates increase as a sign of stress, right? People are looking at this as a possible canary in the coal mine for some sort of disruption that the Fed will take a look at. However, there isn't real credit distress. People are not talking about a default cycle. There aren't companies that are really struggling to raise money. And frankly, they've got so much cash and a long runway before their debt matures. So when does this become a problem is actually something that's a key question for a lot of investment managers right now.
Saw treatment after the surveillance nap yesterday, folks. John Farrell out front what everybody was writing 3 hours later. John, the Italy dynamic in Europe, give us an update.
7 days of gains for the Italian 10-year yield, Tom. In those 7 days, up 55 basis points. Now, the level might not concern you at 183. I think the speed might for this ECB. That spread has been blown out again, Tom. That's got to be of some concern for a European central bank that still might not hike interest rates until the back half of 22.
We're going to stop the show. Brian Levitt will understand. How can Italy have a 183 and we have a 195? I mean, I don't get that.
Different currency, Tom, different dynamics, different central bank policy, different world.
Let's do a data check. Red and green on the screen. John, what do you see?
Equities down 1/10% on the S&P. The Nasdaq down 38. We're down 1/4%. Yields higher by 3 basis points on a nominal 10-year yield. I know the real yield has got the attention of both you and Lisa. In the FX market, euro dollar down 1/4% and crude backing away. Backing away after getting comfortable in the 90s for some people at least. 89.60 on WTI, Tom, down 1.9%.
A little off there today on oil. Brian Levitt joins some Invesco, their global market strategist. Levitt channeling the study of the laureate Paul Krugman. Brian, you are looking at the late 1940s out to the great disinflation and deflation of the early 1950s. Are you telling me we're living post-World War II America?
Well, I think it's an interesting analogy from the perspective of you ended up with a lot of pent-up demand being unleashed on the economy when the American soldiers returned, but the factories were not prepared to meet that demand, given that many of the factories had been repurposed to build armaments. So what you ended up getting was a significant spike in inflation, only for that to come down in the following years. Now, I'm not sitting here saying we're heading towards a deflationary environment. What I'm suggesting is, as the American consumer starts to suggest that they've had it a bit with higher prices, and as every business is rushed to rebuild inventory, could you see a more promising sign a year from now of an economy that has done a pretty good job of rebuilding supplies? That's what we'll need to see.
Is that what a soft landing is, Brian? How would you define that?
Yeah, soft landing, Jonathan, would be if you start to see these inflationary pressures come down, allowing the Federal Reserve to undershoot or back off its tightening stance. You know, already the markets are pricing in 7 interest rate hikes, and could you see the Fed come in under that? You know, that'll be the challenge. We saw that in 2015, first rate hike backed off. You had a slowdown, economy reaccelerated. Similarly, 2018 into 2019, a slowdown in the economy, and you reaccelerated when the Fed backed off. But it's going to be a challenge, and investors should expect volatility as we navigate towards that.
How do you position then for a slower economy, but a slower economy with higher interest rates progressively through the year, Brian? Is that just be super defensive?
Yeah, I mean, I would say that you're with real yields rising and hope of moving on beyond Omicron, you could see an environment where, the more cyclical or value-oriented parts of the markets do well here. But my concern is the tightening of financial conditions. And you were talking about it at the start of the hour with what's going on with credit spreads. And so I view the tightening of financial conditions as the big theme for this year. That's driving the slowdown in the economy. That tends to be, you want to be more higher quality, dividend-oriented, lower volatility parts of the equity market.
Can we talk about the transmission mechanism of this, though, Brian? If you have companies that don't have maturities that are near term, when you have consumers that actually are fairly deleveraged, they don't have a lot of debt on their books relative to history, what is going to be the tightening here as yields rise to basically levels that we saw before the pandemic?
Well, I think you make a great point, Lisa. This is not about a high-yield bond market that's forecasting a recession. High-yield bond spreads started at this recent, move up at incredibly tight spread. So investors always have to ask themselves, where are we in the cycle? To your point, cycles end with a lot of excess, and we do not have a lot of excess. Consumers in good shape, businesses are in good shape, the banking system is in good shape. The challenge that we have is elevated inflation and a Federal Reserve that wants to tighten policy pretty significantly. So the high yield bond market is certainly not forecasting a recession. Companies are in very good shape. The challenge is in all of this, does the Federal Reserve feel the need to tighten conditions so significantly to the point that the economy can't stand it any longer? I don't see that as the highest probability. I don't see the rationale behind it. But clearly, if inflation expectations get away from us, they're going to have to move tighter than what's currently forecasted in the market.
A lot of central bankers are saying they're data dependent. And as we've learned over the past 6 months, not all data is equal. We have some that comes out and people say, not a big deal. Others, the jobs report that was supposed to be not important, that ended up being very important. When we look to Thursday, what will be the bigger market impact if it beats or if it misses the expectation?
I think if it misses, and I think if you undershoot, you could start to see a little bit of relief in the market that you're finally starting to see inflation roll over. If it beats the top, look, we've already priced in an awful lot of tightening. Remember, it wasn't that long ago that the 2-year yield was around 0.1%. Today, I think it's close to 1.3 or at 1.3. So the market has already priced in a lot of that tightening. If you start to see inflationary pressures come down, which they should, by the way, you talk about the base effect, you talk about the polls of the consumers saying they've had it, it's not a great time to buy things. You're seeing maybe some signs of hope within the supply chain. Even look at steel prices more recently, look at fertilizer prices, still very high, but coming down. So that's what we're looking for. The good news is the break-evens in the bond market still downward sloping, 5 and 10 year, not forecasting persistent inflation. We're dealing with very unique challenges in a pandemic cycle, and the market would certainly breathe a sigh of relief from some signs of hope.
I didn't expect to welcome a 6 handle 18 months ago. Brian Levitt of Invesco. Can you imagine if I told you that, Lisa, 18 months out? You'll be happy when we have inflation at a 6 handle or maybe a 5.
Yeah, the threshold is pretty high, or should I say low, in terms of disappointing. The idea that we could see such incredible inflation, but it's the pace of inflation, the direction of it, as Brian Levitt was saying. And I think that, honestly, it will be interesting to see how much of recalibration the market will make if there is a miss on Thursday.
The expectation is 7, Tom. I've gone through the estimates. You've gone through the estimates. 7.3 the median, the high 7.6, the low is 7. I think it was Sarah House of Wells Fargo who said a couple of months ago she thinks we'll average 7 through Q1 and then into the unknown, Q2, Q3,
Everybody's
Q4.
got an opinion. John, what's so important, and Rosenberg used to do this at Merrill Lynch, you line up and parse inflation, and it's, I'm going to say, John, 20 or even 30 lines of things moving around in price. It's a lot more complex than just trotting out one number, 7.3%. And part of this, John, on inflation is the overlay of better news on the pandemic. We've heard that from a number of guests this
Without
morning.
a doubt, Tom.
Yeah.
Moving away from the mask mandate in several states in the United States of America, Australia reopening for tourism, Sweden scrapping all curbs altogether. China and Hong Kong doing something else, Tom.
It's got a resonance here with our following, and thank you for the notes on Twitter on our microbiology. And, John, it's important that you disinfect for Pseudomonas aerugina.
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 Okay.
It's really important. This is our medical tip for the day.
I'm going to trust you. Just a quick shout out, Tom. Kathy Jones says, to be clear, I know how to drive. In fact, my dad owned a garage when I was growing up, so I learned to drive all kinds of vehicles, trucks and snowplows. That was a conversation for the previous hour, but I promised Kathy Jones to swap that. Also this, Ed Ludlow on the West Coast, Tom. We've got to do this shout out. He's driving into the office in San Francisco. His driver, Aaron, listens to us every morning, so we've got to give him a shout out.
We're up to 42 listeners. That's great.
That is great.
That's great.
The other 40 are in-house, and I think there's one down under, Tom, in
Aaron
Australia,
saw
right?
narrative shift open for Jefferson Starship. Good morning, Grace Slick.
Good morning, Aaron. From New York City with Tom Keene, Lisa Brabbitts and Jonathan Ferro. Futures down 2 on the S&P. We're down 0.05%. From a beautiful New York City, good morning. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. In Canada, Prime Minister Justin Trudeau is blasting the protest by truckers that has now halted commercial traffic to the U.S. at what is the busiest border crossing. The drivers say they won't stop until all the COVID health restrictions are lifted. Trudeau says the protesters are hobbling the economy and trying to undermine democracy. There's been a flurry of diplomacy prior to today's resumption of those Iran nuclear talks in Vienna, and it suggests that negotiators are trying to close in on a new agreement. The deal would likely allow Iran to resume exporting oil in exchange for limits on its nuclear program. And in the UK, consumers held back on spending last month. According to Barclaycard, the value of card purchases rose 7.4% in January. That's compared with the same month in 2020. That's the smallest increase since April. Barclaycard says 9 out of 10 adults are concerned about the impact of rising inflation on their finances. And big changes on the way at Peloton, the fitness company whose share price plunged after a slowdown in demand. The co-founder John Foley is stepping down as CEO and will become executive chair. He'll be replaced by the former CFO at Spotify and Netflix, Barry McCarthy. Those moves are seen as a victory for activist investors Blackwell's Capital. Peloton also said about 2,800 jobs will be cut. The Australian electric vehicle charging company Tritium will build its first U.S. factory in Tennessee. President Biden and Tritium CEO Jane Hunter will make the announcement today. The plant will be located east of Nashville, is expected to create 500 jobs and make as many as 30,000 electric chargers a year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Hello, Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
I'm frankly deeply skeptical that the Russians are truly going to pull the trigger on an invasion. Part of the reason for that is because, frankly, what we've seen in the last few weeks has been the strongest display of U.S.-led multilateral coordination that the world has seen since after 9/11.
Ian Bremer of the Eurasia Group, the president there, on the prospect of an invasion into Ukraine, an invasion that the Russians continue to deny any thought of. Futures unchanged on the S&P. On the Nasdaq, we're down 20. We're down about 1/10% on the Nasdaq 100. Into the bond market, yields are higher by a couple of basis points to 193.96. It gets your attention, Tom, at the front end through 130. Up a couple of basis points there. Not just the US, in Europe too. In Italy, we are up for a 7th straight session. Yields higher on an Italian 10-year. And with that, euro-dollar just a little bit lower. Euro-dollar, that currency pair, negative a third. Just about holding on, Tom, to 114.
On hydrocarbons, we come down off the 93 Brent level to $91 a barrel. This is an important moment. We speak often with French Hill, Republican from Arkansas, and now on the GOP and really the state of Arkansas politics away from all that's going on in Washington. We need to note that he's the most popular congressman in America Valentine's Day, because he is the congressman of Romance, Arkansas. You come out of Little Rock and go up Route 5 to Romance, Arkansas. Have you ever delivered an envelope to Romance, Arkansas, French Hill, with Valentine's greetings?
Well, you will want to know, Tom Keene, that all of my wedding invitations were mailed in Romance, Arkansas. So I'm a big believer in the post office at Romance, and it's an economic magnet for lovers all over the nation.
You know, Jonathan Martin in the New York Times 6-8 months ago had an absolutely wonderful piece on the cauldron of GOP politics in Arkansas. It is arguably the litmus test of the future of the Republican Party. What has changed in the GOP debate in your district, in your state, in the last 6 weeks?
Well, in the last 6 weeks, we're talking about redistricting. In my district, I lose part of Pulaski County, Tom, which is Metro Little Rock, and I pick up an additional rural county, Cleburne County, which is next to 2 big counties that I already have in that region. And I'd say the party has become definitely more conservative as we see Democratic quorum courts out in those rural counties having county judges run either as independents or switching to the Republican Party. That's a major trend.
All right, as we help Tom Keene curry favor with his domestic situation, I'm wondering, for Valentine's Day, given the fact that prices are going up, I mean, aside from that particular holiday, how do you expect to address the fact that it seems persistent? How do you expect to address the fact that, yes, the president is leaning on the Federal Reserve, but there is a legislative aspect to this?
Well, Lisa, as I've said for many, many appearances on this program and other programs, we need to not be spending so much borrowed money in such a continued pandemic manic manner. We need to go back to pre-pandemic spending priorities on the fiscal side, while the Treasury withdraws its accommodation on its balance sheet in terms of the amount of Treasury securities that it's buying, and then slowly lifts interest rates. Well, those are 2 key points, I think, to lowering inflationary expectations.
Congressman, in fairness, we are cutting spending, that actually you're seeing this fiscal drag that everyone's talking about, and it is going down. And there is a feeling that if the government does invest in things like renewable energy and certain programs, we could avoid some of the shocks that we're seeing currently with oil. What's your view on that?
Well, look, you look at the Energy Information Agency's predictions for needed fossil fuel production, electricity increases between now and 2050. You're not going to produce that through renewables alone. It's not physically possible to do that. We need to continue to replace our reserves and increase our supply in fossil fuels. And I believe sincerely that we should continue to invest in cheaper, more efficient, more effective nuclear power in this country and around the world in order to fuel the energy demands that both industrial and consumer needs are projected to need over the next 25 to 30 years.
French Hill, the linkage here on a constructive jobs report Friday with a lot of amendments, we get that, is wages up, and we've got the inflation report coming out on Thursday. Tell me about near fully employed Arkansas, and this is your wheelhouse as a former, local banker. What is the wage story you're hearing from business in Arkansas right now?
Well, first, we're about 9,000 jobs below February 2020 before the pandemic, Tom, in terms of employed Arkansans. So that's a key point. And I'm seeing wage pressure increase both at the low end and the high end, particularly in healthcare, for example. In your previous discussions this morning, you talked a lot about low-end working salaries going up and being on pressure to go up. But we're seeing that in the professional ranks, particularly in healthcare, where these wage increases that we saw in the pandemic just to get people to stay on the job, they're being embedded into the system. So we're seeing wage increases in the 4 and 5% range and higher. And I think that's reflected in the 9% producer price index that we saw at the end of the year.
Congressman, I understand there's a massive game this evening. Should I be watching this one?
You should watch Auburn, Arkansas, Jonathan. Come on, get with the program, move off
what game
soccer
is this? What
and
game
move
is
into
this
American
now?
basketball.
This is basketball
This is Auburn.
Yeah.
It's a team in the South playing Arkansas, another team in the South. They're playing basketball, and we're almost to the
one with
time
your
for
hands.
the Sweet 16.
Oh, that's the one with your
This
hands,
is what you
right?
need to watch.
Congressman, I'll try it out. French Hill,
John,
thank
you
you,
have
sir.
no idea
As
the
always.
morass of Southern basketball you just
The Europeans
stumbled
are very good at
into.
basketball now too, Tom.
No, Paul Sweeney's expert on this on another one of my properties, but the Razorbacks will take it against a surprise. It's a surprise this year, John of Auburn.
I'll check it out.
Huge surprise.
I'll check it out a little bit later. I feel like that the Congressman needed to get off soccer.
I mean,
You need to get off soccer.
Curling renditions, basketball, it's the one where
Can
you
I
use
just?
your hands.
I don't want to let this slide. Have you noticed how Tom always benchmarks to Valentine's Day?
Yeah.
So he'll do this with markets too. He'll always benchmark to Valentine's Day.
John-
the 2-year Valentine's Day 2020.
John, I think we ought to road
trip
from
You
Romance.
want to go down
Romance,
to
Arkansas.
Arkansas?
Yeah, Romance. We can do remote outside the post office.
Are you going to bring Mrs. K with you just to?
No, we're not
make
on
sure you
speaking
stay out of
terms.
trouble? We assumed after all of that.
Yeah.
Yields up, Tom, 3 basis points, 194.50. That conversation there about the fiscal effort down in D.C. You listen to Senator Manchin. For now, TK, it just sounds like it's dead.
I don't. Who knows if it's dead or not? What I know is the election's upon us. The election talk to me, John, feels like May and June, and we're in February.
Yeah, we've got a long time to go. And I keep going back to this point. If they've got anything going for them on the inflation conversation, Tom, so far at least is the calendar. The base effects will kick in the other way, and the hope is that inflation story fades. Whether the sentiment and the polls can turn around before the midterms, I'm not so sure.
And like with French Hill there in Arkansas, there's like 5 flavors of Republicans in Arkansas right now. I thought he was pretty eloquent on that.
5 flavors.
Yeah. There's like old line Republicans, and maybe French Hill's in that group. You got Tom Cotton and others. I mean, it's really complex.
Meet the Bramo Cam.
No, it's French Hill, French Vanilla. Honestly, I was just struck by which spending is good and appropriate right now, which spending is not at a time with inflation.
I thought we were breaking this one down, Lisa, making it smaller, passing what we can. Maybe that's the effort through the summer. Futures down a tenth, almost. From New York, this is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Let's talk about this bond market. Live from New York City on TV and radio. This is Bloomberg Surveillance with Tom Keene, Elisa Abramovitz and Jonathan Ferro. Yields are higher on 10s by a few basis points. Let's call it 3 to 194.68. A break of 195 earlier. The high of the session, 195.59 on a nominal yield. It's been a while. July 2019, the last time we were up here, TK. Yields up, equities down by 0.2 on the Nasdaq. No drama on the S&P by not even 0.1%.
Going to have to see what we've got here. Let's look at the trade balance, John. Right now, I haven't even looked at the number yet. I'm behind Michael McKee's skill set. It's a pretty better number. We had an $83 gazillion negative survey number, and it comes in a little lighter. I'll call that just as a quick summary, supportive as well. You're right, John. A 195 in the 10 years, shocking. There's no other way to put it. Let's get to it here on economics as we move to the inflation statistic is what matters if you follow the markets. Laura Ram joins us now, Chief U.S. Economist, FS Investments. I love your language, Laura. You're braced. You're braced, I say, for the inflation report. What are you braced for?
Well, I think we're all thinking that it's going to be creeping higher. Everybody keeps talking about inflation receding in 2022, but it is definitely going to keep going up in the first quarter. And that is something that we all need to be ready for. And it's coming from everywhere, Tom. I think, that all started as a transitory supply chain, you name it. It's really now erupting from everywhere. And that's what concerns me about the impact on the household.
Your forte is the overlay of foreign exchange dynamics into broad economics. So I'm talking to you about goods inflation and what do you see in trade, in foreign exchange dynamics that gives you any inkling about what goods inflation will do?
So, when we look at the global, and you were discussing it earlier, I think you need to look globally at reopening, and that continues to really be a hindrance when you're looking at China and, frankly, a lot of the rest of Asia. So I think the goods price inflation continues, and I think it's one reason why we're going to see the dollar still strong, relative on a relative basis. Even though you have, I think, a lot of concerns about U.S. equity market underperformance that have developed this year.
So then why do you think long-term rates are going to remain below 2% as we eke up closer and closer to that benchmark already?
Lisa, I knew you were going to mention that flag that I planted at 2% on a day when we're right there. But but you got to plant a flag. But I think that at the end of the day, the U.S. 10-year for a long time has not truly reflected fundamentals, right? It reflects global risk appetite. It reflects the fact that the Fed is still doing a massive amount of bond buying. I think to me, the real move can happen towards the middle of the year when we really start to change or renormalize the balance sheet. At the end of the day, when we look at the 10-year and the very, very low policy rates around the world, what we see are flat yield curves, and the U.S. 10-year almost tends to reflect global growth expectations, not just U.S. So for that reason, you've got the U.S. flywheel picking up on growth. We're staying very healthy, and you have a lot of uncertainty around how that ricochets to China. You have the UK data this morning. That, I think, is where you start to get stuck in the mud when it comes to global growth, and why we could see, I think, the U.S. 10-year harder to increase than I think a lot of people think. But, to your point, we're really watching real yields, and it's really moved significantly.
Well, but Laura, just to build on this, we are reaching that 2% threshold faster than you had expected. Does that mean that the end rate is more likely to be higher or lower, actually, in the long run, as people price in not only rate hikes in the United States, but also in Europe?
So this is a dynamic we saw last year, and I'm glad you touched on this, because we had the 10-year rise early in the year, and then it kind of retreated. And that's what I think we're going to get a more choppy outlook going forward. We have already seen so far this year rates volatility just ricochet through FX, through commodities, and through equities primarily. So I think that is the dynamic that really makes 2022 a year where you need to just be, you can't just rely on the rising tide of the big indices. You need to really be more active. Because just because we're popping up now doesn't mean we couldn't get, data later or growth data out of the rest of the world that causes us to correct lower again.
What do you see, though, for consumption? I mean, we're talking about all these distractions. 70% of the economy, 68%, whatever it is the consumer. What's your partial derivative of the consumer, Q2, Q3, Q4?
I think we've already seen it in the equity calls that we had so far. We just are finished with. High-end consumer is going to do great, no doubt about it. But when you dig down into sort of that bottom half of the income spectrum, you're seeing households being, spending being crowded out by higher gas prices and higher food prices. We're all used to volatility at the pump, but we're really seeing food prices creeping up all over. And I think that is why I'm almost more focused on the University of Michigan numbers that come out on Friday, because that indicator, it's very sensitive to inflation.
Well, no, but this is
how worried households are.
Give us a primer on that, Laura. Why does Michigan on Friday matter so much?
Well, when we look at consumer confidence, and we all know that's the canary in the coal mine. We do not get strong growth without a healthy consumer. And so when we think about how inflation could be impacting consumption, and let's face it, I mean, the U.S. consumer, powered by stimulus, has been the hero of this economy over the last year and a half. So looking forward, inflation has, I think, a real threat to sort of slowly take the wind out of that sail. And the University of Michigan numbers in particular have a higher sensitivity. The questions are geared more towards inflation. And we see those numbers now close to the lows, even worse than the Great Lockdown. So that's why I'm really interested in whether or not those numbers reflect very high inflation expectations or a lot of concern about how inflation is going to be managed in the household balance sheet.
So as we see consumer sentiment hit by higher prices, how does this feed through to the labor picture, especially given that small business survey that we got this morning, the NFIB survey, that showed an incredible amount of pessimism around not being able to hire enough people? I mean, will this bring more people into the workforce, or is there another reason for this friction that seems to be incredibly persistent?
No, I mean, I think you've nailed it. I mean, when I say inflation's coming from everywhere, I don't just mean across the spectrum of consumer prices. I mean the wage side as well. We saw that in the Friday's numbers. So I think this is an environment that makes it very tough for small business. You see that, with everything, with hiring, with inventory rebuilding. All of these things are just much harder for smaller businesses to manage than they are for medium-sized businesses or larger businesses. So this is when inflation gets entrenched, and the Fed's trying to get ahead of this, but they're behind the 8 ball right now. That's the game they're trying to play.
Laura, can we tie this all together and really understand where we are in this economic cycle? What you're portraying is an economic slowdown as a result of some of this inflation. However, we're coming off incredibly fast pace of growth. So is this a robust economy where the inflation will eventually be a good thing, or is it a bad thing in terms of leading to another recession?
I think we need to see inflation peak and turn the corner. I think as far as the economy goes, deflation kind of slows everything down. Inflation speeds it up. I think it's going to cause companies to spend on CapEx. We are clearly in the beginning of a massive inventory rebuilding. Some people would say, nah, that's not real growth. I don't buy it. I think it gives us growth that enables businesses to really continue to harness the power to hire and to continue to spend. The real issue to me is whether or not we can get the demand continue to stay strong, despite the fact that the Fed is going to need to just pull rates higher to address, the political box that they're in and solve for some of this inflation.
Laura, thank you. As always, Laura Rain there of FS Investments, going into CPI on Thursday, then on Friday, an important sentiment read in the United States of America on the consumer. Peloton holding a news conference right now, a conference call, Tom, with John Foley, I guess the now former CEO of the company, acknowledging he made some, quote, missteps.
Yeah, taking the high road and, preparing for the new guy to come in and make some tough decisions. I mean, trust me, I've got a wide knowledge of failed investments, John, and that happens. And the great character here is, I guess, they're clearing the market, as we heard from Simeon over at BMO Capital.
The new guy being Barry McCarthy, and the stock in the pre-market, at least, were raising the losses. Now down just 1.3%, not on those comments, obviously, but just on the morning, we were down and gapped lower off the back of it. I think the question for a lot of people, what does this mean for the prospect of a takeover? If we're having this management switch now, are they cleaning this up to make a sale or cleaning this up to make a bigger effort going forward?
Although, of course, as Simeon was telling us earlier, it seems like it's going to be a hard sell to certain companies after the failure of Lululemon and Mirror. At least that's the perception, is that really didn't go as well as they had previously expected. There's also a broader takeaway here, that 20% cut in workers. How often are we going to see cost reductions and, frankly, streamlining some of the employment as a result of the higher costs? Because honestly, especially if you're in an unprofitable tech business that's gotten loads of cash, how do you handle that when the cash spigot gets turned off?
That's not what we've seen, Tom, so far. And Lisa's right to raise the question.
No, it'll be interesting to see, and there's a big difference here between small, mid, and the large caps that take up very much of our time.
Saw the small business conference this morning. Not great at all.
Yeah, and Harley Davidson out today with a cost-cutting program, and they're down the road on it, and they're doing better. They're showing better numbers, and all of that is about this productivity overlay. John, I'm going to go back to what David Stubbs said last year, one of the most important interviews I did all year, where he said technology reigns supreme.
Stubbs, he'll be very happy you've gave him a name check just there, Tom.
No, but I'm sorry. It's a big deal. I mean,
I agree with you.
Technology front and center.
Some comments from the French leader, the President Emmanuel Macron. Putin told me he wouldn't be at the origin of an escalation. Macron saying results after the Putin dialogue will take time. Russia, of course, repeatedly denying any plans to invade Ukraine. From New York City with Tom Keene, Lisa Abramowitz and Jonathan Ferro. Futures negative on the Nasdaq, down 43. We're down 1/3% on the S&P. We're down 1/10. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. France's President Emmanuel Macron says Vladimir Putin told him that Russia would not escalate further around Ukraine, but Putin didn't offer any specific details. Macron met with the Russian leader yesterday in Moscow. Today, Macron is in Kiev for talks with Ukraine's President Volodymyr Zelensky. The U.S. is losing patience with China regarding trade commitments reached during the Trump administration. American officials say they haven't seen any real signs of Beijing making good on its agreements. China pledged to buy an extra $200 billion billion in U.S. agriculture, energy, and manufactured products through the end of 2021. And billionaire Peter Thiel is leaving the board of Facebook's parent Meta to pursue Donald Trump's agenda. Bloomberg's learned that Thiel will focus on backing Republican candidates for Senate who advance the former president's policies. Thiel has advised Facebook founder Mark Zuckerberg for almost 2 decades. And a divided U.S. Supreme Court has dealt a blow to minority voting rights. It's reinstated an Alabama congressional map that creates only one district likely to elect a black representative. A lower court had said federal law required a second one. A high court's ruling ensures that Alabama voters will use the original Republican-drawn map in the November election. The state is 27% black. And Pfizer forecast 2022 sales and profit that fell short of Wall Street's estimates. The drug maker's expectations for its coronavirus vaccine and recently cleared oral therapy disappointed investors. Pfizer's fourth quarter profit was better than expected, though. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will be make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
If inflation does continue to build and wages respond to it, the question will be, do central banks play catch up? Are they willing to accept a much sharper downturn in growth, possibly even something worse than a slowdown in growth? We know that a lot of tightening cycles typically end in some kind of contraction in GDP, or do they sit back and still take it too gradually?
Janet Henry, HSBC Global Chief Economist. That was a wonderful conversation, really, really valuable to talk to her about the HSBC view, which, as we've heard through the entire show this morning, is maybe not in too large a panic over rising yields. Red and green on the screen, the VIX 22.98. Lisa and I are watching the 10-year yield. We just had a 195 there as it marches up, not to recent highs, but nevertheless, that is the trend this morning. With Barry Ritholtz, and yes, he's a columnist for Bloomberg Opinion, there can be an eclectic view of investment, finance, etc. But there's also a dark side of Ritholtz you don't know, which is he thinks hard about the American society and the fabric of our unique capitalism. Barry Ritholtz has been thinking about this with some important Fed data. Barry, one of my favorite books is my great mentor in the United Kingdom, Meghdad Desai, of the London School of Economics, and the book is Marxist Revenge. Is Marx getting revenge for an out-of-control American capitalism that gives us wealth disparity?
So there are two ways to look at this. One is the income generation and wealth accumulation side. And then the flip side of that is the tax structure that was set up in order to run the country, run society. And what we've been finding is that some of this is intentional. You could look at the Reagan tax cuts, very much wanted to unleash the entrepreneurial spirit by creating all the incentives. And then some of these are just unintended consequences. Look at the Bill Clinton rules to limit executive compensation by forcing them, and follow this, forcing them to take stock compensation instead of cash. And we know how that worked out.
Well, but Barry, and that's exactly where I wanted to go, because this really brings into the focus the central bank and some of the low rate policies that people say have fueled some of the gains on said stocks that have been able to, and I know that's a highly controversial. A lot of these stocks were actually of companies that did really well, et cetera. However, I am wondering, can you dovetail the Fed's role in this? This is highly controversial about whether they're exacerbating the wealth inequality or helping to solve it by keeping rates low enough to allow employment to be more inclusive and broader based?
It's a really complex question, and there are no easy answers, but a broad framework for thinking about this. Historically, we've had monetary and fiscal policy working together, and anytime we've moved away from that, we've tended to exacerbate the wealth inequality. So post-financial crisis, hey, listen, anytime the U.S. equity markets are down 57%, I'm a buyer with both hands. Other than the first drop post-29, that's been a fantastic generational entry opportunity. And we have this false myth that somehow we've democratized trading because it's free and that we've democratized investing. The Federal Reserve, Z1 flow of funds report shows that the vast majority of equities are held by the top 1 and 10%. It's a little less disproportionate for real estate. It's somewhere in between for privately owned businesses. So when we think about wealth, stocks, bonds, real estate, businesses, it's not a surprise that Fed policy has helped those assets. At the same time, what we saw with the CARES Act in 2020 and 2021, fiscal stimulus tends to help the bottom half of the income and wealth pool. And while their wealth hasn't gone up dramatically, we've seen a huge catch up in wages for the bottom half of society you could credit the fiscal stimulus for that, not the monetary stimulus.
So, Barry, at this point, I mean, the reason why this is an important conversation, for a lot of reasons, it has a huge implication on society, but also on the trajectory for a Fed that has a much broader mandate right now. They want to decrease this gap, as many people want to see, between the rich and the poor. Is this something that they're factoring in to actually keep policy easier for employment, or to actually tighten up? Because right now, who they're benefiting the most, arguably, are the wealthier individuals who have money in the equity markets.
Well, you know, again, it's complicated. The Fed is trying to benefit the entire economy and financial system, and in a winner-take-all society, who stands to benefit the most when the broad economy does better? It's the wealthiest. So I want to just separate the wealth accumulation gap from the income and opportunity gap. You know, one of the most important things that we can talk about is economic mobility and the opportunity for talented, hardworking, skillful people to go out. In the United States has fallen over the past few decades. I think that's the underlying root of the problem. We'll never make the world equal. We'll never make sure that everybody has the same amount of money. But at the very least, we should make sure that everybody who wants to go to a decent school, get an education, get a career, have a profession, that those opportunities exist. And we've seen that slip in the United States since the 1980s.
Barry, thank you. Writing for Bloomberg Opinion, really thoughtful here on what we're seeing in the distribution, on the income statement and the balance sheet for all of America. Futures -5, Dow futures go the other way. I'm going to call it red and green on the screen. The VIX more constructive, but to be honest, Lisa, the whole thing's got a feel of waiting for Thursday.
Yeah, waiting to understand what that inflation read's going to be, how that trajectory of data influences the moves by the Federal Reserve, by the ECB that have already been priced in. God, it's such an uncertain picture. I just wonder what could potentially tip the scales one way or another at this point.
I get this a lot, Lisa, and what I say is, okay, how many textbooks do I have at home on this stuff? And is any of this right now in those textbooks? And maybe it's in the behavioral, Kahneman, Thaler, Schiller at Yale. Maybe it's in that area, but in the mathiness of economics, this is all original.
How much is a fleeting consequence of the biggest health crisis going back to the Spanish flu?
I'm there.
And how much is this a structural shift that was accelerated? Yeah. You've got all of these influences, and to try to come out with some prediction is why you get such incredible disparity between opinions.
Didn't have a time there to talk to Barry Ritholtz about the reality of the gains from all the fiscal adjusts that we've seen off the pandemic. That'll be a debate for another day. We need to prepare you for Thursday. We'll do that tomorrow here on Surveillance. There is some economic data, but really all looking towards Thursday and the Great Reset. Loved what Laura Ram said, where she said she's looking at Friday and those behavioral statistics, the confidence statistics and inflation data from the University of Michigan. 10-year yield we're watching 1.95%. That probably right now bears close scrutiny. Coming up, the Democrat, always interesting from Maryland. This you'll hear on Bloomberg Radio and see on Bloomberg Television. Van Hollen of Maryland in the 12 noon hour. Stay with us. This is Bloomberg.
SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Yields higher, equity softer. From New York City this morning, good morning, good morning. Your price action shaping up as follows. Negative 0.1% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, a synchronized global bond market sell-off.
If you look at just the bond market, we are making an adjustment higher in yields.
The Fed has pivoted.
We're at a turning point.
The new regime underway.
The environment is one of tightening policy.
As it relates to the bond market.
When you start to see these types of moves,
it's this fear that the Fed is going to overdo it.
There are some limitations as to how high these yields can go.
As the Fed and global central banks pull back,
that's going to cause some challenges.
The Fed is further and further behind, and they're going to have to catch up.
These rises in yields are now starting to have a negative feedback impact on credit spreads.
Spreads are widening out
because of the adjustment going on in the bond market.
Yeah, that's going to be a bit of an overhang for the next couple of maybe weeks or so.
Joining us now, I'm pleased to say, Pictet's Ella Hodja, Neuberger Berman's Eric Knudsen, and JP Morgan's Jack Manley. Ella, let me begin with you. You think this flattening trend in this bond market will continue. Why?
Sorry, the usual error of Zoom. Apologies for that. So broadly speaking, the setup that's driving central banks to pull policy tighter from the monetary side is still intact. In the sense we're still facing high inflation prints as we speak, although that is a lagged indicator. And at the same time, we're looking at a growth backdrop that's still benign and above trend. So with that in mind and the types of valuations that we saw rise over the course of last year, pretty much across all asset classes, the setup for central banks is to continue to tighten monetary policy.
And Eric, it's not just the Federal Reserve, it's not just the Bank of England, seemingly it's the ECB now as well. So we've got some synchronization here, Eric, in a way that we didn't in the previous tightening cycle of the Fed. Let's talk about the destination. How far do you think they can take this?
Well,
Well, we're definitely entering into a global tightening cycle. In fact, it started last year with emerging market central banks, most of them raising rates late last year, Bank of England, Norges Bank, and you know, what we're looking at right now is more what's priced into markets. There's no doubt that central banks are moving to rate hikes. The Fed will hike rates this year. We think it'll be more like 4 than 5 this year. As there will be, you know, kind of pressure on the growth side. And what we're looking at is whether markets are going to be trading rising rates and inflation, or we think there's going to be alternating days where they start to focus on the growth side and the concerns that growth is not as robust as expected, in part because of the impact of rising rates. So we think there will be more two-way markets around interest rates, having seen this big move, rates up to 194 and 195. You know, we think that the 10-year or our 10-year targets around between, say, 2.1. We've gone a lot of the way there. So we actually would be looking to take down some of our duration underweight here, buy back some interest rate exposure as markets get more two-way in the short term.
Well, certainly we've done a lot of work very, very quickly year to date. Looking at that 24 dot in the Fed dot plot, Jack Manley, 2.1% is the median dot in 2024. Bill Dudley, formerly the New York Fed, called that fancy land. He thinks they've got to go much, much higher. As you think about the destination and how far we can push this, I'm just looking at the belly of the curve start to lift up a bit again. Are you questioning too, Jack, the destination, the end point of this Fed hiking cycle?
I think absolutely, John. I mean, when we look at what's going on with the Fed at the moment, very clearly it feels like it's been backed against the wall, given the strength of the labor market, given the strength of the economic recovery, given the persistence of hot inflation. We'll be getting another print very, very strong this Friday. But I do struggle, John, with this narrative that the Fed has to pull a lot of levers right now. You know, I can see a Fed that can very easily get inflation in check at the moment. The only problem is that it has to sacrifice the consumer to do that. It has to make life so unpleasant for us that we're dealing with higher prices and higher borrowing costs, and all of a sudden the supply chain issues don't matter anymore because the demand just kind of evaporates. The consumer is the engine of growth for this economy. That translates directly into a recession. That's what Paul Volcker did in the late 1970s in the Carter administration. I don't think the Fed wants a recession. And so, you know, I see this narrative of rising rates making a whole lot of sense this year, but the aggressiveness that a lot of market participants seem to believe in, I don't really see that materializing. That 4 rate hike commentary, I'm much more in line with that. Maybe even 3 hikes. Forget about 5, 6, or 7.
We're dealing with high yields right now, that's for sure. 10s at 195, up 3 or 4 basis points on a day, approaching 2%. Kelly Lyons, it's been a while since we were that high.
Since all the way back in 2019, John. So yeah, it's been a while, and strategists are saying that nice round number could be very, very close. We are indeed inching closer to it. 195 is where we sit now, and that is a really key level to watch, Sean, because it is that level or around it where we could see convexity hedging start to kick in, where those holders of mortgage funds need to start hedging against the potential ripple effects of higher yields, and therefore need to sell treasuries in order to protect their portfolio. So that could be a potential catalyst for even further higher yields. You also could see a catalyst from the auction slate this week. At the risk of sounding like Lisa Abramowitz, we do have a lot of supply coming online. A 3-year auction today, $37 billion of 10s tomorrow, and $23 billion of 30s on Thursday. And speaking of the different maturities across the curve, of course, you've seen the movement in the long end, but where it's really been more dramatic is in the belly and the short end, at more than 50 basis points on 2s and 5s so far year to date. With that repricing of expectations, more aggressive hikes expected, as you were just discussing. And that's not just true here in the U.S. That is a global phenomenon. We're seeing it in a big way in Europe at the short end, and specifically in the periphery with spreads blowing out. Just look at BTPs and what's going on in Greece. And altogether, when you put it together, global bonds, worldwide government bonds, are coming off their worst 6 months in 5 years, John, and those declines continue today.
Kelly Lyons, thank you. Jim Karen and Morgan Stanley a little bit earlier this morning talking about the negative feedback loop that we're starting to see into credit and maybe back into the economy. Goldman's Christian Muller-Glissman is looking at credit for signs that maybe things are getting a little bit tense. Take a listen.
Credit is essentially following the academic world, is essentially short equity put. So the equity volatility should be very closely linked to credit spreads. Maybe the credit market is telling us there should be more concern in equity markets.
Ella, can I come to you on that? Just what's happening with credit versus equity right now and your read on things?
Well, we started to see the proper signs of a feedback loop into credit last week. and is very much led by the ECB, predominantly because they have tended to mop up a large quantity of the supply on the European credit space, and also because we have a much larger supply backdrop in terms of credit, particularly in this side of the world. And so that repricing clearly initiated by the shift from the ECB, and it seems to be broad-based. Certainly some sectors underperforming, your typical sectors that tend to do worse when yields go up. So your utilities, for example, came to mind, and your tech sectors as well. And so we're seeing the tentative signs, and there's been a bit of pain inflicted. Now, we're still sort of not trading halfway through to where we traded back in 2018 with regards to the option-adjusted spreads. So there can be more pain to go, if this persists. And so for the time being, the market probably is trying to find its feet, given it's seen quite a bit of repricing over the course of what is a short period year to date.
Are you surprised by the stability you're seeing in equities, given what you're seeing take place in credit?
Well, actually, this started with equity weakness, as we know. It topped out in November, began in December, and really took hold in January. So actually, we would say probably credit markets have been following equities here. So surprised? Probably the answer is not. We're seeing unprecedented monetary policy tightening at a very concerted pace. So it's not just happening in the US, it's happening in Europe now and elsewhere. And so that, generally speaking, tends to create repricing room for risky assets.
On the tightening, there's two ways of looking at this. Bank of America on the one side, JP Morgan on the other. This from Savita Subramaniam at Bank of America. She says the following: we're tightening into an overvalued market. The S&P 500 is more expensive ahead of the first rate hike than any other cycle besides '99. That ended poorly, and that you know. JP Morgan on the other side of this saying the following: the Fed is unlikely to keep moving further and further into hawkish territory, at least relative to what is priced in currently. Eric, who are you closer to at the moment, Bank of America or JP Morgan?
I think where Jack was, as he said earlier, we've got JP Morgan in the house, that the Fed is going to be very, thoughtful about their rate hikes here. They're less likely to, really slow the economy too much. They're going to be very data-driven, and that, as we said, as I mentioned earlier, the markets are going to begin focusing on the growth side as opposed to the rates and inflation side. And I think that's going to create a lot of short-term volatility, short-term sloppiness in markets. You're seeing it now in credit markets. You saw it first in equity markets, and the Fed's going to be paying close attention to that. I think the key question is around recession. We think odds of recession remain very low over a 12 to 18 month time horizon, and that informs the opportunities to take advantage of some of the sloppiness and add to positions, whether it's in credit markets, equity markets, as opposed to expecting, significant drops from here in markets.
Jack Manley, if your conclusion is that the Fed ultimately underdelivers relative to where the market is priced, where does that leave your equity exposure concentrated right now?
So, I still think because we are seeing this rising rate environment, we should expect continued volatility this year. We should expect those more expensive parts of the market to continue to blow off steam. That's not going to surprise me. What we want to look for this year is earnings, and we want quality of earnings. We want consistency of earnings. Now, that may mean value. It may mean cyclicality, but it doesn't just mean those things. Technology is under a lot of pressure right now. It's getting kind of beat up by a lot of people talking about the sort of end of this longer-term growth trade. You have to look, even in technology, there are high-quality companies that are able to deliver those earnings. So, when I think about equity markets this year, John, it is more a sector and security selection story. It's more an active management story than really anything else. It's not a beta play anymore. There's a lot to be concerned about right now, I think, as an equity investor, but there are plenty of ways to get around those problems through prudent security and sector selection. So still very positive this year when it comes to what earnings can do, when it comes to what prices can do. We just have to be a little bit more careful about where we are looking.
We'll build on that into the opening bout. Jack Manley, Eric Knudsen, and Ella Hodger. Let's get you some movers pre-market going into the open for more. Here's Abby.
John, lots of outsized market movers here in the pre-market, starting out with the shares of Harley-Davidson. The stock is popping after the company beat revenue estimates by 21%, also posted a surprise fourth quarter profit on higher prices, consumers digesting those higher prices. Also, importantly, they see supply chains and logistics improving in the back half of the year. Now, Coty up 3.7%, strong quarter there. Stock is higher. Novavax up down 8.7%. There are reports of COVID vaccine deliveries missing the mark. They're really under-delivering on their promises around the COVID vaccine. And then Pfizer down 4.5%. They missed the fourth quarter revenue estimates on COVID product sales. The outlook is lackluster, showing signs that perhaps the COVID boom for them may be coming to an end, John.
Abby, thank you. Coming up next on this program, the US and Germany presenting a united front.
Germany and the United States, together with our allies and partners, are working closely together to pursue diplomatic resolutions of this situation. And diplomacy is the very best way forward for all sides, and we both agree.
That's next. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
If Russia makes a choice to further invade Ukraine, we are jointly ready, and all of NATO is ready.
Diplomacy efforts continue. The US and Germany presenting a united front in D.C. as President Macron travels to Ukraine after speaking with Vladimir Putin in Moscow. Macron telling reporters he received assurances from Putin that Russia wouldn't escalate further around Ukraine. Russia has denied any plan to attack the country. Joining us now from D.C. is Anne-Marie Hordern, and from Brussels, Maria Tadeo. Maria, let's just wrap things up. What we've got through in the last 24 hours and what's still to come through today.
Well, there's a lot of diplomacy going on. Of course, Olaf Scholz was in D.C., but in particular, I would argue that it's Emmanuel Macron that's making real news today. He met Vladimir Putin yesterday for almost 5 hours. The French are saying that for them, they didn't really get anything on paper, but they believe that the situation is not escalating and it's not worsening. So for them, that's good for the time being. And then, of course, he is in Ukraine as we speak. He just did a press conference in which he said, and this is very important to stress, that at no point the French suggested that Ukraine Ukraine should become Finland or anything that looks like Finland in this situation. And the way he looks at this, there's two problems that are happening. One is in eastern Ukraine, and the only way to deal with this is through the famous Normandy Forum. Remember, this is Germany, Russia, Ukraine, and France in talks. And then there's a bigger question around NATO. He did say we can talk about NATO, but before we get into that, we need to make the situation stable, and then we can talk about innovative solutions. But before that, Russia has to really prove that they're willing to de-escalate the situation.
AMH, yesterday was a massive opportunity for Chancellor Scholz to tell us what he stands for. Were the German government happy with that visit?
I think they were. Listen, he came out and he was a little bit more emphatic than he has been of all things on the table. And then when the reporters were really questioning him, why will you not say the words Nord Stream 2? Why are you not saying definitively, as the President of the United States just said, Nord Stream 2 will be completely off the table and it will not go ahead if there is a further invasion of Ukraine? He switched to English. I think he was trying to show that he is in sync with the United States and with the allies when it comes to the harsh sanctions package they are preparing for Russia. And then, Jonathan, he went on CNN, he said Germany is ready to take steps that will have costs for us. This goes back to his line about how they want to make sure they are prudent because no one should be under the guise that any sort of sanctions on Russia are not going to have a blowback on them. Just quickly for a little bit of context, Olaf Scholz is in a difficult position. He's part of the SPD party, and their own party is engaging diplomatically within themselves. Domestically, they are at a crisis of how much they want to talk tough on the Kremlin because this is a party that wants to engage in Russia. Also, this is something he inherited. Former Chancellor Angela Merkel, she championed Nord Stream 2, and she came under pressure in 2020 after the poisoning of Alexei Navalny, the opposition leader, that they should scrap this project, and she went ahead with it.
AMH in DC, alongside Maria Tadeo over in Brussels. Guys, thank you. Thank you very much. Crude this morning, 90.21 on WTI, negative 1.2%. On Brent at 91.44, negative 1.3%. We caught up with the CEO of BP a little bit earlier this morning. This is what he said.
A lot of uncertainty, but what I will say is that demand is strong, and you can easily see a further tightening market throughout this year. But more than anything, I think we should expect some volatility, and at the end of the day, we don't know what the price of oil is going to be.
And nobody really does. Jack Manley, this has been a hot part of this equity market. Energy in a commodity market, crude flying year to date. Do you want to chase this?
I think you could probably chase it for a little bit, John, but to me, it's too tactical and it's too uncertain. You know, I would agree that there is clearly a good amount of demand for energy products at the moment. But to my mind, so much of what's going on with energy prices right now is much more supply driven. And you can really go all the way back to the start of 2021 and point to different instances throughout the course of that year that contributed to oil being at the price that it is right now. I don't think WTI should be trading at $90 a barrel. I think especially with the United States as the marginal producer in global energy markets, we could see oil fall off $20, $25 before it settles into an area that is a little bit more sustainable. Now, short term, there's a lot of risk to that supply side story. And so, of course, we could see oil prices move higher, especially if there are sanctions against Russia in the event of an invasion of Ukraine. But as things stand right now, John, the fundamentals to me don't really support this story for long-term energy outperformance. But to tell you the truth, I was saying that last year and it didn't really work out in my favor. So there's so much uncertainty. I just think we need to be aware of that.
Well, at least you're honest. $25 would take us back to about November, December time, by the way, because the rally has been this quick and this strong. Eric, your thoughts on the energy sector in the equity market, where we've seen some fantastic performance in the year so far?
Sure. This time I'll take the other side of Jack. We'll take oil between 90 and 100. We think that the supply-demand imbalances will continue to put pressure on oil price, all within a much more volatile environment. So I think that's very important. We're going to see major fluctuations day by day, but at that level, the global economy has worked just fine for periods in the past, and we think that we're likely embarking on a longer-term commodity cycle where supply-demand imbalances, the need to move towards the decarbonized global economy and everything around that, along with what we think is likely a weaker dollar going forward should put pressure continue to apply upward pressure on commodity prices. And in a cross-asset environment, we think that it can be helpful both in terms of the positive return opportunity, but also helping to hedge against what we think is likely some structurally higher inflation going forward.
Ella, you get the final word on this one. Final word.
From a bond PM. We would say, I would say we're more in line with Jack, sort of medium term, down the line because of the lower exploration and lower oil rigs that we've been seeing. So there could be a pressure on oil prices further down the line for years to come, and the energy transition is likely to be more inflationary than not on the energy side, at least for many years to come. This year, it's a different story for us. We're a little less bullish on the growth backdrop. Of course, we would be, we're global bonds. But broadly speaking, we see the demand setup to be weaker this year around, and predominantly that has been driven by China, particularly on the commodity side of things. So we think there could be some surprises for commodities over the next 6 months. So different story, short term to medium term.
Ella Hodger sticking with us alongside Eric Knudsen and Jack Manley. Coming up on the programme, the morning calls, and later, strategists divided on Wall Street as the earnings pour in. From New York City, this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Minutes away from the opening bell, equities just a bit softer, down a tenth on the S&P, down 0.25% on the Nasdaq right now. In the bond market, yields higher through 195 on 10s, 195.77, yields up by 4 basis points. You have to go back to the summer of 2019 to see yields this high on 10s, on 2s. 132. That's the price action here in the morning calls. First up, Wells Fargo cutting its first solar price target to 88, expecting higher rates to fuel a rotation out of renewables and growth stocks. Morgan Stanley downgrading GM to equal weight, forecasting a challenging year ahead amid rising execution risk. That stock is negative 3.51% to 48.93. And your third and final call, BTIG downgrading Airbnb to neutral. The analysts citing concerns about slowing growth and overly optimistic earnings expectations. We're down 3% in early trading to 153.10. From New York, coming up next, division on Wall Street. There always is. Morgan Stanley expecting weaker earnings as UBS bets on robust growth. Equity futures a little softer on the Nasdaq. Your opening bell is up next.
prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Equities are just about holding on here from New York City. Good morning to you all. This morning, the price action down 1/10 on the S&P, no drama so far. On the Nasdaq, down about 1/3% on the Russell, down a single point, negative 0.05%. The opening bout in New York City rings, switch up the board and get to the bond market. We look like this on 10s. Yields breaking out again at 4 basis points and pushing 196, 195. 59, not just stateside, on the other side of the Atlantic too. In Europe, look to Italy for a 7th straight day. Yields are higher in Italy, 187, let's call it 188. In 7 days, we're higher by almost 60 basis points. So keep going back to this. Think about the move we've seen year to date in 10-year yields in America. It feels brutal, right? We've done more than that in 7 days in Italy as the ECB tees up doing something maybe in the back half of 22. In the FX market, euro dollar just a little weaker on the euro side of things. We're negative there on that currency pair, 0.2% to 114.17, and crude backing off 1.6% on WTI to 89.85, down about $1.50, down by 1.6% to be precise. As we open things up on the S&P about 50 seconds in, we open negative 0.01%, positive now, no drama. Bottom of the pile, communication names, we're down 0.4% at the top off the back of this move in treasuries. Yields higher, treasuries up, yields up, financials up by 0.7%. Here's the quote from HSBC that got our attention. It reads as follows: we think the next big thing to cut will be cyclicals in Q2, as it will become increasingly clear that global growth momentum decelerates in earnest. The crucial question then is whether the Fed is more likely to hike 3 or 7 times from the current 5 being priced in. Eric Knudsen, that's your world. That's what you're thinking about. Why is it so important?
Yeah, I mean, that path of the rate environment, and again, whether markets are trading inflation and rate increases or a declining growth environment, is going to be critical for the market setup. We do think that we won't go with HSBC in terms of the timing of that. We think there's more room for cyclicals to go here. We want to be underweight unprofitable tech and to a certain extent big tech at this point through another portion of the period here, get through kind of peak hawkishness with the first rate hike in March, and then see when in the second half of the year we start shifting more towards that orientation towards growth slowing versus inflation and rates. I will say that the other aspect here is that volatility is going to persist. We want to be able to take advantage of volatility. So another way to play this exposure is to express some of those views in the options market through selling options and capturing attractive volatility premium at this cycle, point in the cycle.
Ella, there is a difference between deceleration and weakness. Growth is set to decelerate. It doesn't necessarily mean it will be weak per se. Ella, your thoughts on that?
Well, the consensus entered this year thinking that growth would decelerate. So we don't think that would be the surprise for markets. So you have to think that this deceleration is probably already reflected in the price. So what would be the surprise would be if indeed we actually trade much lower than that in terms of the prints that we get. That would probably catch central banks off guard because they're also operating on the basis that growth, although coming off from the very high levels of last year, will still remain at elevated levels. So that could change the macro backdrop pretty significantly.
Jack, two pieces to this call. Global growth momentum decelerates in earnest, 1. 2, cut cyclicals. Jack, where are you and the team on cyclicals at the moment?
Yeah, I would generally speaking agree with what Eric had to say, which is that I think there is more room to run than just through the second quarter on cyclicality. And I think a lot of that has to do with the fact that, particularly in the U.S., there is still more momentum from a growth perspective. You know, I tell clients, I don't think we're on the cusp of a paradigm shift where value or cyclicality is going to outperform over the next decade relative to growth. I don't think that is the case. But if you look at the high-frequency economic indicators that are out there for things like the travel industry, leisure, hospitality, you see how these things got beaten up because of Omicron. I think there is at least a couple more quarters of strong growth sort of to come before the economy starts to settle back down into a more ho-hum kind of pedestrian pace. And if that is the case, it is those value names, it is that cyclicality that is more levered to that growth story. In particular, John, and I've said this before, so I know we've talked about it, but I do still like the financial story. Now, a lot of that hinges on what the Fed ends up doing. You know, how effective is it in controlling the shape of the yield curve? But I am generally speaking an optimist on that front, and I think that this could be a really nice environment for big banks to make a whole lot of money as long end yields drift higher and that curve maintains some sort of steepness, or I should say steepens as QT begins in earnest.
Let's come back to that call on banks in just a moment. Two earnings stories I want to pick up on. Pfizer, number one, down 5% of the open after the outlook misses estimates for 2022, just about in positive territory. Peloton, after getting absolutely slammed yesterday, that's up by about 1.5%. On the West Coast, let's get to Ed Ludlow for more. Hey, Ed.
Yeah, morning, John. Peloton bouncing all over the shop. And the big news is that John Foley, the CEO and founder who brought this company into being a decade ago, is stepping aside and becoming executive chair. Barry McCarthy, you see there on the right hand of your screen, he's a former CFO at Spotify, former Netflix executive. He comes into the fold as CEO, and the street likes this, John. JP Morgan's Doug Ammuth calling this a known entity move, somebody that's very familiar with subscription-based businesses. And that's the story for Peloton, right? That's what we want to know about the future. How do they manage and transition to a higher margin services and subscription-based revenue? But it also raises a question about the other elephant in the room, John. Does this increase the likelihood of a sale? Because one of the barriers or fetters to a takeover by the likes of Amazon or Nike was this dual-class structure and Foley being a holdout, basically, right? It makes sense. He was the founder. This was his baby, but he'd come under criticism for his management and abilities. You see there, that chart says it all, right? We're well around that IPO price. It's been an 80% drop from the peak of the pandemic. And the story's been that, you know, folks have gone back outside of their living rooms and started using gyms. So the big question for earnings after market today, what is the future? Even if it's not a sale, what is the strategy and how do these C-suite changes make that happen?
Ed Ludlow, thank you. I should say it got slammed last week. Massive pop yesterday off the takeover rumours, up 21% yesterday, almost 21% at the close, up 4% right now on Peloton. Last week on Thursday, that was ugly at one point, down 9%. It's had a tough time more recently. More earnings. Let's get to Abby for a whole lot more than that. Hey, Abby.
Hey, John. Well, you know, it's super interesting because, of course, all focus on the CPI print later this week and the inflation story that we've all been watching. So far, it's not really affecting U.S. companies on an individual level. In fact, we're seeing a lot of consumer companies in particular really absorbing consumers absorbing price hikes, and that margins are staying steady. In fact, this morning, we had Harley-Davidson report a much better quarter than expected. Sales up 21%, a surprise profit. Those price hikes being absorbed. Tyson Foods yesterday, consumers really absorbing those rising prices as well. That said, margins are not hanging in there for all companies. Right now, for the first quarter of this year, margins down almost a full percent from the peak back in the second quarter of last year at 13.9%, currently at 13%. Nonetheless, you can see relatively holding steady over this year from relative to last year outside of this trough right now. And interestingly, if we break it down just a little bit more, we're seeing a real shift versus the prior year in margins. Communications getting hit pretty hard, discretionary as well, staples down just a little bit. But if you can see it, people seem to want it. Materials and industrials, that cyclical call that one of your guests was just talking about, well, right there, you can see that the margin is hanging in for those two sectors. John.
Avi, thank you. 8 minutes in, unchanged on the S&P and the Nasdaq, just about positive 0.06%. Let's talk about the small caps. Julian Emanuel of Evercore weighing in on the small caps. He writes the following: small caps have shown signs of sputtering below their prior support, with Russell 2000's recent track record as a leading indicator for broader market weakness. We will be watching the reaction to this level closely. Eric, can I come to you on the small caps in America? A lot of people talking up this as a potential part of the market that will be okay with rising rates, inflation being a problem too. What are your thoughts?
So in general, we want to be overweight small caps. The category, by and large, is pretty sensitive to economic growth and reflationary pressures. That said, what we think is incredibly important at this juncture is to focus on kind of quality versus non-profitable small caps. Over a third of the Russell 2000 index are comprised of companies that are not profitable. That's the category that's the portion of the category that's really gotten hurt this year, and we think will continue to face pressure. You can combine that orientation towards smaller companies that are geared to reflationary growth with quality earnings, quality management teams. We think that's a great opportunity set right now.
Jack Manley, your take.
I think what Eric said makes a whole lot of sense, and I'd add on top of that that there is a very compelling valuation argument to be made on the small cap side of things, particularly on the small cap cyclical side of things. You do want to look for that quality. You do want to look for the ability to generate earnings. You do want to look for solid management, but I do like the idea of small caps. I would just say that any client or investor that is thinking of getting into the small cap space needs to recognize that it is inherently a more volatile part of the market. It's not going to do the same thing as large cap, very high quality kind of blue chips name will do in a portfolio. So understanding that there is more risk associated with that space, I do like that play. I do like that call that Eric made, that I think we want to have a little bit more exposure to small caps than we typically would otherwise, just because of that strong growth story, that strong reflation trade.
Jack, you mentioned the banks a bit earlier. Let's finish there with you. Why the banks work in a world where you think the Fed will disappoint on the level of rate hikes that are currently priced?
Yeah, John, it's a little cheeky, but I'll tell you how I think about this. I don't know where you bank. I won't say where I bank, but I can tell you when interest rates are at 0, I get about 1 basis point on my savings account. The Fed could hike interest rates to 2% tomorrow, and I'll still get about 1 basis point on my savings account, right? A lot of these big banks are able to hold a lot of that extra money. They're able to eat up all that upward pressure on rates by passing it on to you on the long end of the curve when it comes to lending for autos, for mortgages, on your credit card debt, as some examples. The net interest margin story there is, I think, a lot more powerful than the overall yield curve that some people may be focused on, because even if the Fed were to normalize short rates, if we were to see a flattening yield curve, that doesn't necessarily end up being what the end consumer feels. And so I look at this environment and I see long end yields drifting higher, especially if the rest of the world starts to normalize as well. That is an environment where net interest margins lead to enhanced profitability in those big banks.
Jack, if Jamie's watching, you should tell him now that you bank with Chase, just to clean it up and get ahead of a problem. You should bank with Chase, I imagine. I want to finish on this with you, Ella. The potential for a steeper curve, you push back against that. You believe in a flatter curve from here. Is that a global call for you, Ella? Does that include Europe as well, or is that just the Treasury market?
Right, so yes to flatter curves, and that's predominantly because the market still needs to find what the end point is with regards to terminal rates. Does it join the Fed, which we've been doing, so we're moving in that direction, or as we were saying earlier in the session, potentially even higher. So very difficult to say here. We'll need to assess the growth and inflation backdrop, but we are certainly on the camp that thinks quite a lot is priced in the curves here. 7 hikes from the Fed is pretty excessive. So in order to not disrupt the growth backdrop, you need to kind of pull back from the amount of hikes that you have in, at least over the course of this year. So that's on the US. On Europe, we had been more on the sort of steepening curves debate, but clearly the shift from the ECB is actually pointing in the other direction. And you saw 10-30 swaps in Europe actually start to invert following the ECB meeting, which is telling you that the market thinks the policy setup there is also getting pretty tight or excessively tight. So we're certainly seeing more value in flatteners there, with the belly of the curve, so the 5-year part of the curve, still exposed, in our opinion, to continued repricing.
Ella, thank you. Awesome to have you on the programme. Ella Hodger there with Eric Knudsen and Jack Manley. Coming up, what a contrast. Australia opening to tourists, Sweden scrapping its COVID curbs, mask mandates slowly going out here in the United States, and Hong Kong going the other way.
It's biologically implausible to eradicate or eliminate an efficiently spreading respiratory virus that has an animal host. So COVID-0 was wrong from the beginning.
COVID-0 on China, on Hong Kong. That's next. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
That you're going to see many of these mask mandates at the state level stand for much longer. And indeed, many states, including my own in Pennsylvania, have not had a mask mandate for months and months.
What a contrast. Let's just sit on this for a moment. Sweden getting rid of its COVID curbs, basically all of them. Australia reopening to double-vaccinated tourists. And here in the US, state after state making a move. Connecticut, New Jersey, Delaware, all dropping school masking mandates. Over in Hong Kong, we're going the other way. The chief executive, Carrie Lam, saying this: now given this severe epidemic, I hope the public will accept that we have to go back to the most stringent level of restrictions. Bloomberg's Mike McKee joins us now for more. Mike McKee, that is quite a contrast.
It is quite a contrast. Changes in latitudes, changes in attitudes. It's all about the virus and where it is hitting. And for us here at Bloomberg, it is about the economic impacts and, to a lesser extent, the political impacts of all of this. I want to start north of the border with Canada. Oh, Canada, that bridge that's been blocked by truckers between Detroit and Windsor, Ontario, carries 25% of the U.S. and Canadian land trade traffic, and it is a major impediment to trade in the U.S. and Canada. Truckers still disrupting life in the Canadian capital, Ottawa. PM Justin Trudeau today accusing the truckers of trying to blockade our economy, our democracy, and our fellow citizens' daily lives, which is interesting because this comes just as U.S. states are starting to loosen up. As the pandemic fades, we're seeing Connecticut, New Jersey, and Delaware announcing they are going to start phasing out mask mandates for school children. And then you go across the pond, and Italy ending its outdoor mask mandate. Austria, Sweden, the Czech Republic going to let most of their mandates lapse. Even the Germans are talking about it. In Australia, border controls being eased. That's not enough for protesters who blocked roads in the capital of Canberra there. Protests also in Wellington, New Zealand. Most of the easing, as I mentioned, comes as COVID cases are falling rapidly around the world. But Greg Valle, who's the political analyst at AGF Investments, wonders today if the protesters are going to take credit for this, leading to even more protests, not just about COVID, but about other social issues. No protests in Hong Kong, though. As you mentioned, leaders there increasingly adopting the mainland policy of no COVID, zero COVID, limits on gatherings imposed today. Residents also dealing with some food shortages because truckers can't make it across the bridges to Hong Kong.
Mike McKee, two different worlds. Thank you, sir, on the latest of these restrictions. A number of years ago, when Chinese state funds started to go into the equity market, it was quickly called the Plunge Protection Team. Do you remember that? We used to have that name for what happened in markets here in the United States a while ago, too. Overnight, apparently that's what we saw. Equities bouncing off the lows, reportedly because state-backed funds came into the market to buy Chinese shares. We get to Damien Sassow for more on that. Hey, Damien.
Hey, how are you, Jonathan? So, yeah, that's exactly right. The market was down 2.4% overnight, and then the Plunge Protection Team came right in and got the market back up to where it needed to be, I guess. Look, China's equity market is in a bear market. I mean, it's down 20% off of last February's high. The reality is this. What is driving the weakness? It is weak consumer spending. It is weak tourism. I mean, tourism receipts are down 70% year over year in China, at 70% since pre-pandemic levels, sorry. And movie box office receipts down 20%. All this data is coming in. We knew it was going to be a weak Lunar New Year holiday, Jonathan, but not this week. And so on top of that, you see BABA listing shares here in the U.S., which means SoftBank selling. You see 33 new entities added to, a U.S. kind of banned list. So, yeah, you had quite a bit to drive the market lower. And of course, here comes state-backed funds in China riding to the rescue once again.
Unreal, Damien. They're going in one direction. We're going in another. Globally, we have to sort out the supply chain situation as well, Damien, and I just wonder how we do that. Dr. Amish Adauja of Johns Hopkins was on with us earlier this morning on Bloomberg Surveillance, and he said the Chinese, China, Hong Kong, they're going to find it very difficult to open up.
Yeah, no, impossible. I mean, zero COVID just can't work. I mean, look, we all know this. It's a matter of whether or not they relent. I mean, look, if you believe that China's going to stick with it, they're going to have to cut rates. They're going to have to front load all of their total social financing inflows in the first half of this year. And what's that going to do? It's going to drive rates that much lower. I mean, 3-year China-U.S. yield spread is now 70 basis points. 70 basis points. It was 300 in November, Jonathan. 300. The 3-year spread between China and U.S. yields is at 70 basis points. That means the yuan has got to depreciate from here.
Damien, people can criticize the Plunge Protection Team and laugh about it, but do you take some real signal from that?
Absolutely.
Isn't that important that there is a real shift taking place?
Well, what they're buying, right? I mean, what were they buying overnight, right? They were buying utilities, energy, and financials, and not just any financial. They weren't buying property developers. They were buying brokers. They were buying banks. So it just goes to show that's where China's head is at. And, you don't really want to fight the PBOC and you don't want to fight Beijing.
You've got to listen. You've got to pay attention. As always, Damien, thank you, sir. Damien Sassow of Bloomberg Intelligence. Let's get you some sector price action this morning. As always, we can do that with Kriti Gupta. Hey, Kriti.
Well, good morning, John. Well, it's pretty clear what the story is in the stock market. It all really comes down to the cue that the bond market is leaving. Your leaders this morning are going to be financials, utilities, and materials. Financials, of course, following the lead of that 10-year yield, which is nearing 2%. With it, you also see some other yielding sectors in the green. Utilities, consumer staples as well, nudging higher. But your laggards are once again going to be big tech and energy, which is actually taking a breather. Pretty normal, just given the run-up that sector has had. One of the biggest weights on an individual level is going to be NVIDIA, though. This, of course, comes off the ARM deal that now actually really fell through. SoftBank saying instead they're going to pitch it as an IPO. So, of course, weighing on NVIDIA, not just for the S&P 500, but for the SOX index broadly. But today, on an intraday basis, the SOX index actually in the green. You'll remember, John, it wasn't too long ago where chip makers and EVs were actually booming, and this idea that this was going to be the next big thing. In this year, however, in 2022, that is not the case.
I used to interview the CEO of ARM when it was listed in London, and now we're talking about relisting it after buying it. And pretty good to thank you very much. I think Anna Edwards earlier this morning said it was back to the future for the likes of ARM and maybe others too. Equities this morning down about 0.1%. Coming up, the market moving events you need to be watching. That'll be next in our trading diary from New York. This is Bloomberg.
Capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Five minutes into the session this morning. Good morning to you. We're down just a little bit on the S&P by a little more than 0.1%. Banks lead here. Bottom of the pile. The Nasdaq down about 0.2%. Let's get you a read on the why. It's in the bond market. We can talk about twos and we can talk about tens. Twos right now at 133. Tens at 197. Almost the highest since the summer of 2019. A 40 basis point plus move year to date so far. That's the price action. Let's get you the trading diary. The US auctioning $50 billion of 3-year notes at 1 p.m. 10s and 30s later in the week. President Biden delivering remarks at 1:45 Eastern Time. Wholesale inventories coming up on Wednesday. Plus, we'll hear from some Fed speakers too. Then a little bit later in the week, another read on inflation on Thursday. CPI, the big one, and initial jobless claims coming as well. We round out the week on Friday with the University of Michigan Consumer Sentiment Survey from New York City. This was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away. Because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1,
and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation. A language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings. As someone described about. Hey, Ruchita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be in the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, And the parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We got a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
They're stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park. And inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 meters of sky gardens, reflecting pools, waterfalls, planter terraces, and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per 1,000. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges, or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while, and I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G. And it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology, and live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。
不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高。但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the years through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes, and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king would be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce. And he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
没有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to, show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. and they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers. And it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaxi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate, and that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters off Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Inna Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1996, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Inna wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
solar and wind energy were fully commercialized, there were a lot of amazing technologies implemented everywhere, I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded EcoWave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station. This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level,